Welcome to Charts This Week. My name is David Linton. I run Updata, and quite a big week in markets last week. Run through again this week, and in fact we're going to look at the S&P to start, and quite a lot of charts the S&P. And I think in setting this up this morning, what reminds me of technical analysis markets, a lot of people think you just look at one chart and that's it. In fact, to really do a proper analysis you have to look at several charts to get the picture. Here we have a monthly chart of the S&P 500 index. I know a lot of you don't look at the monthly chart, but you should, because it can convey information that you will not see in the daily and the weekly charts. And what's most interesting, we've had really about a 100-point run from about 1050 to 1150 this month on the S&P, making it really one of the biggest months, if not the biggest month, for several years. We haven't seen a month like this, an up month like this, for many years. So September was really quite an outstanding month for financial markets, assuming the next few days continue in that manner. So really quite key that we've seen that. And then if we go to the monthly Ichimoku chart, here we see in the cloud that we really have tested right on the cloud. We came back up into the cloud, we've tested on the cloud. We're not really fully bullish on markets on the monthly chart. We need to break above this cloud for that signal. But of course we do take a lot of comfort in the fact that we've tested this cloud on the lagging line. It really is a strong indicator that markets look bullish in the long term, so quite a good indicator there. And we see how we tested the cloud back in 2000. We're doing something similar here, so quite an interesting part of the picture. If we go then to the daily and the weekly charts, we see that in fact we've got a very interesting level now. We broke this 1130. Remember, we said 1130 was quite key last week. We've now smashed that level. We're through on the daily very clearly, above on the weekly. So we've got quite a lot of bullish support on markets. I know a lot of people find that hard to believe with all the sentiment that's around, but the markets are looking quite good in the medium to long term again. Certainly the medium-term picture is quite bullish. But of course, we did have a big move last week, and the markets have smashed this 1130. So you need to go down to the hourly chart, and this is the whole point of charts, is looking at the multiple time frames. If we go down to the hourly chart, we see here that we did get the cross around beginning of September. We crossed on the hourly. This has been the trend on the 60-minute chart, and we through this 1130 level. This has really been quite critical through that last week on the hourly, and now where would this run end? We look to the hourly chart and we see that really this 1130, what was resistance, is now rapidly becoming support as we go up the trend. So keep an eye on the 60-minute chart on the S&P. If we cross this cloud, especially with the lagging line, then the shorter term move might be over and we have to then look to new levels. So that's what we need to watch out for. If you run fast quickly, you then go to the hourly chart to see that. And of course, the point and figure charts will lend an extra dimension to this for you. And here we see that we've got a new target of 1300. We showed you this last week. It has been activated, so this is really quite key now. Last week activated the 1300 target on the S&P, and I've put in here the risk-reward ratio. Those of you who are using these targets on your systems will know about these risk-reward ratios, and here we see that we've got 1.4 as the risk-reward ratio currently, if we fall back through the stop of 1040, which was a sort of previous low. So this risk-reward ratio is calculated on the distance to the target, the distance to the stop, and what's that distance, the target distance over the stop distance, and the ratio is 1.4. And normally for favourable trades we're looking for around 2 to 1, 3 to 1 is ideal. So it's not a highly favourable trade, but it does suggest that especially if we're prepared to go all the way back to that stop of 100 points lower, but it does suggest that we've got good upside on this chart. So this is a 10 by 3. If we go to the 5 by 3 chart, we see 1320 as the target, 1270 target given a long time ago, and 1235. So we've got quite a lot of upside targets here. And if we come in on this chart, now if we're prepared to use 1120 as our stop, which is the little mini low that shows up on the 5 by 3, then we've got a risk reward ratio of 6 to 1, and that's very very good, but possibly a little bit tight on that stop. 1120 is not a long way below, but if that is the risk reward of 1320 versus 1120. So we have got favourable risk-reward ratio conditions here in the trades. And then if we go to the 1 minute chart, because of course we ran a long way last week, the 1 minute targets, we see 1149 was given as a target way back on the 3rd of September. So at the start of this month, this upside target was given, 11.49. We closed on Friday at 11.48.67. So, okay, we're a third of a point off the target, but really quite impressive how this target has been met. Quite bullish confirmation that. We do have an upside target which was given around the middle of September of 11.55, but it's not a long way off now. So, and consequently the risk-reward ratio is not very good because we're very close to that target now. If we look at FTSE, the 6,500 target has now been activated on the daily chart. That has a risk ratio of 1.8 if we're prepared to live all the way back to 5,100. So that is actually quite a favourable ratio on FTSE. If you're prepared to live with 500 points downside, you've got potentially 1,000 points upside. It's around 2 to 1. So getting this risk-reward ratio is quite key in terms of understanding what you're prepared to go to and how much you'd be prepared to live with in terms of your risk. So quite a favourable looking conditions there on the FTSE. And if we go to the 5x3 1 minute chart, we see the shorter term targets, one that's in train at the moment, 5,790. 5,685 is really our next upside target, so about 85 points upside, and here we see the risk reward ratios kicking in. But we also do have this downside target, and we need to watch these 1 minute charts as they develop for how the picture changes. So the price action that's going to occur in the next day or two is going to give us a little bit more of a picture. Looking at the DAX, what's most interesting about the DAX is that FTSE and the US market made new highs last week. The DAX isn't making new highs this year, so we know that something is different there. So I went to the relative. Here we see the DAX versus the S&P. We see that we went pretty well sideways here at the start of the market, so not a lot of difference. And then we outperformed on the DAX going sideways, US market falling, so the DAX is outperforming, and now the DAX is underperforming because we know that the US is making new highs and the DAX isn't. Normalize this with currency though, and what a change you see. We see that the DAX really underperformed because the euro was weak in the first bit. Euro is now being a bit stronger. So even though the DAX didn't perform as well as the S&P last week, the currency is having an effect. Dollar weakness coming in there. So that's quite an interesting picture if you're a dollar investor looking at the German market. Gold. A lot of people commenting on gold. Of course, gold hitting $1,300 and people saying it's a bubble. It's not a bubble. A bubble looks something like this, where the chart's going completely vertical. This is not a bubble. In fact, we haven't really made a lot of progress on gold in the last year. If you look at it, we're up maybe less than 10% overall where we've had these highs. So it's not like gold's doubled in price and doubled again. This is not a bubble. This is a trend, new highs, and we know from previous charts this week, we know we've got targets into the around $1,500 level on the long-term charts. But of course we have run a lot, so that makes you want to look then to the 60-minute chart. We look at the 60-minute chart, we see the trend in gold. We got the signal around the 14th of September that gold had crossed from negative trend to positive trend on the 60-minute chart. So that told us we had several days of good trading potentially ahead in gold. We've run up this trend. We now need sort of really a fall through 1280, 1285 would signal that this run was over. So that's the place to look for how long does this gold thing go on. Look at the 60-minute chart. Of course, go to your point and figure charts for the targets as the price behavior develops. That's it for this week. Until next week, happy charting. See you then.